let's say that you're in the fortunate position that you've owned a bunch of gold and silver and they've run up so much that you're like, wow, this paid off. Look at you equity people. I was right all along. And now you're like wondering whether you should add more or take some off. How would you think about it, given that you're about to launch a fund which will, I believe, invest in gold and silver?
Let's say you do own all of these assets in their own individual funds. Anytime you need to think about rebalancing, you do need to think about the tax impact. When you sell a little bit of gold or silver or whatever else that you might want to reduce, it is a tax incidence, so you're going to be having to pay taxes and then sort of moving to the other assets. What a multi-asset fund does for you is it takes care of all of that. There are no taxes when we rebalance within the fund. Saving on those taxes is one big plus. The other is in terms of actually thinking about when to increase or decrease specific assets. You talked about gold and silver. Now, both those assets saw very sharp run-ups in the last few months and then saw some significant volatility in the last couple of weeks. Now, the question becomes, should you keep holding? Should you reduce? Should you add? What should it be? The right answer really is not about whether you should do any of those things, but what is the allocation that allows you to be okay with it, irrespective of whether both of those assets now go up another 30% or correct 30%. And that's really a function of us using a systematic rules-based process as opposed to trying to predict which of these is going to do better over the next 6-12 months. Taking that decision load off is, I would say, one key value prop that a multi-asset fund like ours kind of brings to the table.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.